Hello and welcome to Market Masters. Today we are in conversation with the top markets team at Nomura. It has been an incredible last few weeks. Massive, not exactly reciprocal tariffs, stock market selling off hard, bond markets throwing a big tantrum, a 90-day tariff pause, markets napping back globally, with the exception of US assets, dollar US assets, which kept getting sold, and over the last few days, some repair and recovery in US assets as well. A complete roller coaster. What is the roadmap from here? Is there a roadmap to begin with? It's my pleasure to speak with the top team at Nomura. We have with us here Rob Subbaraman, Head of Global Markets Macro Research at Nomura. Craig Chan is Head of Global Forex Strategy. Sonal Varma is Chief Economist, India and Asia, ex-Japan. Saion Mukherjee is India Head of Equity Research. Sonal and gentlemen, thank you very much, all of you, for being here. It's been an absolute roller coaster ride. And, I was joking, saying that I'm getting up earlier and earlier every day and getting to office later and later. so much overnight news to digest, right?
Yeah, it feels like what's happened in the last 3 months usually takes 3 years or longer to happen.
Yeah, I mean, and you think of it, it's what, only 10%, not even 10%, 5% of Trump's term, 4-year term?
Yeah.
I mean, if you calculate the number of days. So we're just in the beginning. These trade deals now, I think, is what markets are focused on, Rob. What's your sense? Are they going to get done quickly? Because markets are swinging between optimism to despondency. What is your sense?
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, tariffs are going to have a big macro effect on the US economy, and economies everywhere this year is our bottom line.
So with China, we've been hearing what we've been hearing over the last 48 hours. Should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was, before elections, said 60%. So will we get down to 60?
We could get down to 60. And that has been our kind of a longer-term baseline, around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. And it's going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates. We've just added another 2 cuts for the ECB this week to our forecast. Many central banks we have essentially cutting while the Fed's on hold.
Got that. And do you expect a recession in the US? Or you think we won't get it? I think your house view is that you escape it, but you get pretty close to it, but don't actually see it.
That's where we are right now. So it's very close. So if you look at our growth forecast for Q2, Q3, Q4, it's 0.1% quarter on quarter. So not much margin of error for negative growth numbers there. So very close to recession. We put it around a 40% chance.
What happens on the 4th of July? You said no deals. 4th of July is when the 90-day sort of tariff pause expires. So we get another extension, and then these negotiations.
I mean, I think between now and then there could be some deals. But what I'm saying is I don't think all the reciprocal tariffs are gone. I think that some will be coming back.
Okay. I mean, what is Craig? Welcome to the program, and great speaking with you. What is your sense in terms of how? I mean, bond markets threw a tantrum, and it looks like there is a bond put but no put for equities Is that the way to look at it? Because as Rob is saying, this is a long drawn-out process, and the big deals are with EU and China, and what really matters for global growth, etc. And if they take a long time, I mean, growth may suffer and markets may swing as well. But have you seen the worst in that sense, dollar assets?
No, I don't think we have. I mean, I just say that what we have seen so far is actually just evidence of some outflow. Right? It's definitely not been broad-based. It looks like it's mainly on the bond side, where there has been some selling from the Japanese investors, from Taiwanese, to some extent Korea as well. But it hasn't been really excessive. There hasn't been much kind of equity-related selling. Overall, in terms of looking at kind of the value of assets in the US, still exceptionally high. You know, we're talking about the last numbers we have. They're quite old, but I mean, it's like 33 trillion US dollars of foreign investment value in bonds and equities. I mean, it's just surged in the past few years. I think we're starting to see some signs of that unfold.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks.
Okay.
The data is actually
So maybe investors,
mixed.
etc.
It's actually quite mixed. But you know, you have on one hand the treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind. But I just say quickly, beyond the asset unwind, there's also another element around it, and that is there's a lot of investors that put money into the US that actually haven't hedged out the FX risk. Japanese life insurance companies have low FX hedge ratios. Taiwanese life insurance companies have low FX hedge ratios. So that's another risk. They could start selling more dollars to hedge out the FX risk.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities are being. It was basically almost get out of the US. That's
So that
was
phrase,
the
US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading, but at the end is still quite, you know, I think of a push. It's a push to say that.
Because even if, Rob, everything goes back and they say, well, we've made deals, etc. I mean, it's an issue of trust, right? Suddenly you've thrown everything up and, you know, it's kind of, isn't that is the heart of the issue here. When we say US exceptionalism, I mean, the exceptionalism was about the trust in the systems and the institutions, etc.
I think US
that takes a hit.
exceptionalism means different things to different people.
Yeah.
I was going to ask you what you mean by that, because
To some people, it just means tech exceptionalism.
yeah, it's true,
Market
right?
exceptionalism,
Exactly.
but-
And then for others, it means the economy. And US is facing stagflationary effects, which is bad. But then the worst case of US exceptionalism is what I think you touched on, Prashant, is foreigners losing trust in the US dollar as the global reserve currency. And as Craig said, I don't think that's clear yet. But in terms of the US economy starting to wobble and less scope for policy support for it, I think that's quite a valued concern right now.
There's been so many different angles, right? It's been from the DeepSeek fears and the impact on AI. Then it moved to tariff policies, non-tariff policies. Then there's concerns about, you know, am I going to get taxed on, you know, if I'm holding US Treasuries? It's just a lot of policy, as you mentioned, policy uncertainty for investors. And that is going to reduce the effective overweight that we've seen in US assets for many years. And that's what's happening now.
Fair enough. Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I
But
think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, like relative to a number of our competitors, we do have an upper hand.
I just add that, from what we've heard from the White House as well, it's quite clear that India and Japan are way ahead of the rest. There's like 185 countries which have had these reciprocal tariffs. 32 are under discussion. So India is by far ahead.
And the hit to the GDP, et cetera, is also, about 0.4, 0. But of course, it's a moving number. It's a moving target, right? As the tariffs stay.
Yeah, the direct impact is 20 to 30 basis points, but usually in these scenarios, it is the indirect impact that is more important. So whether it's world growth slowing down, hit on IT services, hit on investments, confidence, uncertainty, etc. So for FY26, our view is GDP growth is likely to slow below 6%. So we're expecting a 5.8%. It is below what consensus and the Reserve Bank are looking at right now. But of course, we've made much bigger growth downgrades in rest of Asia, which are more open economies. So of course, on a relative basis, we should be better off.
Yeah, you put that in context. India, a bit below 6% growth. We're thinking China in the coming quarters is more like 3.5%. As I said, US is close to zero. So, yeah.
Europe, Germany is zero. I think many other parts of the world
That's right, yeah.
are doing much better. Sign for equities. We're again back to, equities are snapback, right?
Yes.
And FIs are coming back, about a fraction of what they've sold over the last 8 months or so.
Right.
But they're coming back.
Absolutely.
But, very quickly here we tend to go back to high valuations and you're suddenly scratching your heads, now what, right? And you're waiting for earnings. I think your expectations in terms of earnings is lower than the street.
That's
that
right.
comes off the 5.8% number from Sonal.
Yes. So, yeah, Prashant, so basically, when we look at, through the pandemic, like, from fiscal 19 to 24, we had an, very strong earnings growth, north of 20%. Last year was a slowdown, fiscal 25. Now, fiscal 26 and 27, again, the expectations are around, mid-teens earnings growth. So if you look at, there's a lot of catch-up in earnings which has happened over the last 4 or 5 years. And if you remember the entire decade from 2010 to 20, we were struggling with corporate earnings, right? Consistent earnings cut. It was bound to happen, natural, sort of going back to a natural level of earnings and ROEs was bound to happen, and it happened over the last few years. So earnings to GDP ratio has bounced back. In fact, it's now very close to 2008, which is, just before the global financial crisis.
Sure.
With the kind of uncertainties, that we are currently dealing with, and if you look sector by sector, right, the profit margins are, on the higher side. And we are seeing downgrades there. So therefore, I think that, earnings to grow substantially above, let's say, a nominal GDP growth of around 10% looks challenging, at least in the near term. And that's why we think that we will continue to see earnings downgrade. And on your question on valuations, right, I guess, currently we are just shade below 20 times 1 year forward earnings. We have breached 20 times in the past. especially the last few years. But I think, it's very difficult at this point to, foresee that level of valuation. So far, if you look at, there are, certain things which are in favor, like for bond yields are falling, which is positive for valuations. And the risk premium actually hasn't really flared up. It's still behaving.
But that's a risk. That's a risk.
That's a risk.
And your view, Saion, is local, focus on local sectors, right?
Absolutely.
Consumption, etc. And we'll talk more about that. I had to take a very quick commercial break, here. So allow me to do that. So take that break back with the Nomura top team in just a bit. Welcome back. We're in conversation with the top brain trust at Nomura. So we're talking top-down, macro, economics, and of course markets as well. Thanks very much, Sonal and gentlemen, for being here on this program. I want to just talk about, Craig, if I can ask you, trade wars are also, in a way, capital and currency wars in that sense. I mean, if this were to continue, what is your sense? Can this, and the Trump administration and so many others, have said it's not about tariffs per se, it's about non-tariff barriers, which countries like Japan, et cetera, is also perhaps about the currency. We don't know. Will this devolve into something sort of bigger as we go forward? Because this will take time to work itself out.
Yeah, I mean, there's been quite a bit of discussion about this kind of Mar-a-Lago Accord, but then it's not really intensified because it's really been from, if you want to say, the economic advisor rather than from the top level, treasurer and others actually pushing it, as even Trump himself. But I would think that, if we have further discussions around this, the market could really take this seriously and start thinking about, who exactly would be the ones that would be kind of going along to effectively strengthen their currencies against the dollar. But for Japan, there is a lot of focus on it at this point in time, particularly with...
You think at some point in the next 2 years, we will see a revaluation with countries like Japan, even China, I don't know. Is it possible? I mean,
the US Treasury Secretary's already talked about this yesterday, saying that he doesn't have any particular levels that he's looking at for the Japanese yen. But having said that, if it's about, we don't want you manipulating, we want the market to drive the exchange rate, there's still a lot of risks around that because there is, this potential downside pressure on dollar yen, where if there's a sense that there cannot be a buying of dollar yen from the Ministry of Finance, BOJ, then actually it can be a bit of an overshoot. And then the adjustment comes naturally. So I think for dollar yen, that's definitely one that sticks out to us. The rest, not so convincing.
Okay. Rob, cost of borrowing, right? I mean, there's a lot of debt coming to be rolled over later this year. And that was one theory, that they want that cost to be lower. What is your sense? Is this success, what we've seen so far, or will we see?
I think the jury is still out on long-term cost of borrowing in the US. I think, on the one hand, there's a lot of talk about recession. We're saying it's close. If the US economy does go into a recession and expectations build of the Fed having to cut rates a lot, you could see Treasury yields come down a lot further. But on the other hand, the perverse situation we've seen in recent weeks where you've had equity markets going down, but 10-year bond yields going up, is raising concerns that maybe risk premium is building in the US. And whether that's because of the fiscal situation or because, as we talked about before, maybe loss of trust or loss of confidence in policy making in the US, that can play a role as well. So I think right now, my biggest suggestion to you is it's going to be very volatile, I think, at the long end of the US curve.
Is it really possible, Rob, that President Trump does not care about the stock market? In his first term, I think we used to see him waking up in the morning and mentioning the Dow, right? And he was proud about how high US markets were doing. Not this time, nothing. There are midterms as well. Sure. I mean, The one theory is take all the pain up front, and then, I mean, the good stuff comes later, around the time the I mean, you'd want the markets to do well, right? By the time we get to the midterms. You don't
want
think?
the markets and the economy to do well by then. But yeah, I think, of course, I think everyone would like, all leaders would like their stock markets to be at all-time highs. I think the challenge right now is Trump has shown his hands a little bit with this so-called Trump put. He's come in to try to soothe markets a few times now. And I think the risk is if he really wants to achieve a lot of his longer-term goals, which are going to be disruptive for the economy, markets may test the credibility of that Trump put again and may be disappointed. If he really wants to achieve his longer-term goals, there may need to be economic pain up front.
There's been some talk, Rob, about Main Street versus Wall Street, that maybe, is that credible, you think? I mean, that maybe Main Street is the focus and, Wall Street perhaps takes a backseat.
I think that's one way to spin the narrative, right? To say Wall Street has to take some pain. We're trying to bring manufacturing jobs back, boost the manufacturing sector, help Main Street. Another narrative is to blame the Fed, say the Fed should be cutting rates in this environment. So there's a few things here where you can deflect the blame a little bit, I think. But I think ultimately it's going to be very interesting in the coming months. One of the concerns I have with all the tariffs is Main Street, not Wall Street so much, but the small companies that are not listed on the equity market could face a lot of cash flow problems as their costs because of the tariffs go up.
Absolutely. Sonal, what is your sense? Will this China plus one is not new, right? But it's again, I think, got one more lease of life. Is that going to happen? Manufacturing and companies, supply chains moving to India?
I think it's already happening, and the smartphone is a clear example. Even if China tariffs come down, but they stay, let's say, at 60% for the next 4 years, that automatically means that manufacturers will need to look for an alternative, because for the low and the mid-tech manufacturing segments, and I would include the entire bunch of electronics, toys, textiles, footwear in it, these are low-margin businesses. You cannot work with 50, 60%.
In 2018,
tariff.
the shift happened to Vietnam and Cambodia, especially footwear, textiles, etc., right?
That's
out of
right.
China.
That's right, but it was also a lot of the Chinese firms themselves that were investing and trading via Vietnam and Cambodia and Thailand, which is one reason why I think actually the reciprocal tariffs on these countries is fairly high. So this is different from Trump 1.0, i.e.
The main difference is substantially higher tariffs in China. I mean, even if it is not 145, but it's not 10, it's not 20, it's higher.
Exactly, which is actually the US goal of strategic decoupling from China, which is tariff on China and higher tariffs on countries that are allowing transshipment to happen, on behalf of
So basic
China.
manufacturing, essentially, right?
I think, yeah. So what we call essentially the low-tech, mid-tech manufacturing. So smartphones, but the broader electronics, you could think about personal computers, printed circuit boards, more high-end legacy kind of semiconductor chips. Toys, China has a market share of 60% in the world. We are at 0.3%. I think there's substantial scope for India to gain on this front.
Saion, for an equity investor, what does this mean? I mean, this is all obviously, it'll take time, right, to play out. But in some sectors, maybe we will start to see.
See, I guess, equity investors do look at long term, right? So I think that narrative of China plus one, and as you mentioned, that, probably we haven't seen much of success. But the thing is, we are probably better prepared now. And with the differential tariffs, if it comes in, maybe we get a boost, on that. So I think that narrative can sort of, continue. So I think from a equity portfolio perspective, I think this China plus one themes, should be there. I think, though I know some of that are expensive, but they're still delivering on earnings, unlike many other spaces where we are seeing earnings cut. And if this narrative sort of sticks on or gets a little bit of more boost and people get more confident, I think that's one space, we think one should be positive on. But otherwise, I think wherever you have international demand-related concerns, right? I think whether it is IT services or anything where, you are exporting and you could see a sudden fall in demand, I think that's the space to avoid. So that means, one has to look more domestically and focus on more domestic, sectors.
Sonal, to the point of, and so Saion said he likes consumption as a play as well. Do you think the RBI, of course, has done a lot to ease liquidity, but credit demand is still slow? Do you think more needs to be done? What is your feedback? Are things going to pick up a little bit in terms of domestic demand itself, or it needs help, more help?
Transmission takes time. So this turn in, policy and liquidity is just 2 months old. Usually transmission takes like up to 9 months. And now you're fighting these global headwinds. So, the effort will need to be double what we thought previously.
So double RBI plus government?
I think mainly RBI, but I think the combination of the rate cut plus liquidity in terms of, faster transmission. And within consumption, the urban discretionary is more sensitive to global fluctuations, job market. But the rural side, can be a defensive, of course, in this environment. Low inflation is a fairly, big positive for real incomes on the consumer side. So relative to exports and investment consumption, as Shan was saying, should be, better off in the next 12 months.
Last word, Sonal, to you. How long before we see a deal? I mean, do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. COVID hit in Feb. We got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day, but the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
Yes.
All right, fair enough. Saion, Sonal, Craig, Rob, thank you very much. I have a lot more questions, but completely out of time. So we need to do one more of these over the coming weeks, months, and I think it would be lovely to do that. Thank you very much.
Thank you.
Coming by.
Loved it.
Well, that is Market Masters, the Nomura Brain Trust. Thank you very much for staying with us. More coming up in just a bit.